Well, they're all sort of related, especially the jobs number and the Fed and potential rate hikes. The Fed has a dual mandate to not only temper inflation and manage money supply, but also to keep employment strong at full employment. So if we start seeing weakening in the jobs numbers, look for the talk out of the Fed or future action by the Fed to be tempered a bit. So either way, this jobs number is going to tell a tale for how the Fed reacts at its July meetings and furthermore into September.
Yeah, but what about earnings? I mean, Mark, we are expecting the guidance to be negative, and, you know, we'll see how the second half plays out. But do you see any evidence that the second half is going to show any significant change to what we saw in the first half of the year? We're about to begin earnings season in a week. Where do you expect we will see the real guidance from corporate America?
I think we've reached some peaks in the economy, whether it's peak inflation or peak power in the labor market, wage growth, and I think we're going to start to see weakness. As the Fed tamps down on inflation, they're tamping down on economic growth. They're making it tighter and more difficult for people to buy cars and homes, have excess money and spend. Home equity lines have dried up. That piggy bank has gone away. Sure, consumers are still relatively strong, but they're spending down those savings now. And I think as the consumer slows in this consumer-driven economy, we will see some tightening to earnings. We think earnings estimates will come down. We think economic growth slows down, and all of this could lead us to what we think is a mild recession. Fortunately, given where we are with 3.6% unemployment, we don't see a massive deep recession. You just don't get that sort of slowdown when the labor market is a sub 4% unemployment.
Well, yesterday we heard from a number of Fed speakers. Bullard said that the base case is for a soft landing for the U.S. economy. Let's take a look at where yields are. The 10-year Treasury is pulling back this morning below 3% once again. But Goldman Sachs is cutting its second quarter GDP outlook. They're cutting it now down to 0.7%. That's 0.7% growth. That's down from 1.9%. Mark, I know you say that this is going to be a modest recession. Is that why you're seeing a bit of a rally in these last couple of days? We are talking about a 4-day winning streak. Would you buy tech here?
Well, I hate to be on the same side of the Fed and calling whether or not the recession is going to be mild because they don't really have a great track record around it. The premise for that is that we're still relatively strong on the unemployment numbers and the consumer. And I think this Fed in particular is particularly sensitive to devastating the labor market. The Biden appointees as well are going to be a bit more dovish after this July meeting. So that's why I say it's not going to be too severe. I think the movement in the tech stocks is telling. Quickly, I think if the movement in the tech stocks is telling because growth does well in a slowing economy. When the growth rate in the economy slows and investors want growth, I think they're going to bid up growth stocks and quality tech, cash flowing, big cap tech is where I think money will flow. And that's where it's been flowing the past month. Big outperformance from tech relative to the overall market this month.
Yeah, I mean, this is one of the longest winning streaks we've seen, I guess, you know, in several months. But you are still expecting a 75 basis point hike when the Fed meets in 2 weeks?
I do. And then they're going to sit on it in August, and then we're going to look to see in September. And I think we're back to the 50s, and we're going to begin to taper a little bit because, as I said, I think this Fed's going to be a bit dovish, especially with those recent appointees talking to Powell and listening to the people on the Hill who, and as you saw in some recent hearings, came down pretty hard on Chair Powell for raising rates and causing this economic slowdown, or at least influencing it.
Alex Sanchez, you're hearing a lot of commentary from the banks, the Florida Bankers Association, obviously seeing an impact from policy out of this White House climate change agenda, as well as this Federal Reserve slamming on the brakes. Weigh in here.
Thank you, Maria. Mark, look, we're very concerned that, and I agree with you, the economy is slowing down. But you're right, the labor numbers continue to hold up this economy. If that changes, with the Fed pouring cold water on this economy by raising rates, my question to you, Mark, is, don't you believe that by the end of the year, if not sooner, the Fed's going to reverse a course and start lowering rates?
Well, I think they'll pull back on the rate hikes, so we're in agreement there. I don't think they're going to show that much of a reversal. That would be a total capitulation. But I think if they just stop raising rates or get to the 50, then to 25 and taper, and that's going to send a huge signal, it'll have the same effect. I think the lag between the rate hikes we've had and the pain in the labor market is going to be several months. And when that percolates, that is when the Fed is going to stop the messaging that inflation's public enemy number one. And that's what stocks will probably take as a very positive sign. That's why we think later this year, stocks rally and the economy flattens, because the work the Fed has done now is going to slow us down through the summer. But I do think Q4 is going to be a different perspective for investors.